This will crash the housing market. I'm your host, Steven Van Metre, and thanks for joining me today as mounting evidence suggests that housing prices are about to come crashing down. Let's take a look where we head over to this headline that mortgage refis are down 50% versus a year ago, when the average interest rate for 30-year fixed rate mortgages have increased from 4.5% from 4 and a little over 4.25% last week. And requests for mortgage applications fell a whopping 8.1% from a week ago, according from the Mortgage Bankers Association. And the refinance index, if you can imagine, decreased 14% from the previous week and was 54% lower than the same week 1 year ago. And this is staggering when you think about these numbers. And let's take a look at what this means, because it has a devastating impact on the housing market. And so let's take a look here at the 30-year mortgage rate, and what you could see is it has been in a decline. So what I want you to think about is, why is demand going down? Because that's the real issue here, is why is demand falling? And it has everything to do with the interest rates. And so let's take a look again. As you can see, interest rates went down from a peak back in late 2018 and went all the way down, and then have now since been rising back up. But look how high they are relative to where they've been in the past. You have to go back to, say, 2013, 2014, late 2016, early 2017, just to find out where rates were. So if you think about, well, what the mortgage market is telling us here, you can see from a demand, and now we're looking at the lending data from the Mortgage Bankers Association showing the amount of people either purchasing or refinancing their homes with an application for a loan. And note here, you can see how the surge of demand and applications was rising. And now, at least the refinance is down 54% from its peak and likely to keep heading lower. And so when we dig deeper into this, what are we finding out? That there's a serious kind of issue going on. And I want you to think about now what this means for the real estate industry, because if you worked in the mortgage industry, and a long time ago I did, and I may have mentioned this in a previous show, but when rates go up and demand goes down, layoffs come, and they don't hesitate. A lot of these companies will be very quick to get rid of people, and when demand comes back, to bring them back. They don't sit around and say, well, let's see what happens. So if you're working in the mortgage industry or know someone who is, they're probably pretty stressed out right now because they know what's coming. Now, I want to go back now and look at what this means in terms of where demand is going. And let's take a look at this chart on the 30-year mortgage rates, and notice how they bottomed in 2021 and have gone higher. Now, let's go back to this previous chart and look where they peaked. You can see applications peaked right there, early 2021, and have gone down. So there's an entire supply and demand component here that people often miss about interest rates in the bond market. And it's really easy to understand, because the average American, if you ask them, where is interest rates going? And this is something I've heard since I was a child. For 40 years, everyone keeps thinking interest rates only go up, only go up, only go up. And yet 40 years, they've been going down. And one of the things we have to understand is rates just don't magically go up because somebody decides that rates have to go up. In order for rates to be higher, there has to be an equivalent demand for rates to be there. And that's what you're seeing on this chart here. So let's go again and look and go back. Notice demand in 2018 started rising. And why was it rising? Because the rates were falling. And what choked out demand? Higher rates. And so what people think right now is that due to inflation and other things, that rates can only go higher. But as rates go higher, demand goes away, and ultimately rates start coming back down. But how does all this translate into a housing crash, you might ask? Well, let's keep going, because purchase application volumes were down slightly for the week, with a larger drop in FHA and VA purchase volume and a small decline in conventional purchase loan. The key here, though, is first-time home buyers who rely on these government programs are increasingly challenged by both the rapid increase in home prices and higher mortgage rates. And if you're on the sideline, if you are one of those first-time home buyers, you already know this, because you're being squeezed both ways. Prices are still high and rates are rising. And do you jump in and take the risk, or do you continue to wait this out and hope that it eventually crashes? Well, let's continue on, because I think you're going to get your opportunity. The number of high-quality refi candidates was already down more than 75% through last week, and these latest jumps will likely cut that population down even further. Now, it makes a lot of sense because as rates are going up, what's going to happen is if you were one of those people that refied or purchased way back, when rates were lower, what's your incentive to refi? There's none. Now, there is one incentive, and that is if you need money. And in a dollar shortage, people do, and you look to your equity and say, you know what? I will pull that equity even if the rate is higher because I need the cash. And that will actually continue to happen, as you can see here. But while we're seeing declines in overall lending activity, cash out lock volumes continue to hold stronger than rate term refis. Again, that's what it's telling us is the mortgage market is saying, hey, there's a dollar shortage because demand for refinancing at a certain rate is gone, but people are still cashing out at higher and higher rates, telling us they need money. And so, but demand is down less than expected, as economists said, in part because there's so little inventory, which is great news if you're a seller. At the current pace, there was a record low of 1.6 months supply of homes in the market in January, according to the National Association of Realtors. There's still a lot of people who can afford to absorb these higher rates. And you might be wondering who they are. Well, we'll look at that in a second because there's some generational wealth and equity gained from previous transactions that keeps getting rolled over. And fast rising rents, and this is probably the big issue here, is fast rising rents aren't offering any relief and may keep some would-be buyers on the hunt for a home. And all that's telling us is due to rents continuing to go up, people are afraid that they're going to continue to rise. And even though prices are higher than people want and payments are higher than they ideally want, they're willing to go out and buy and lock that in because they know where they think they know where rents are going. So keep that in mind of why we'll still see demand. So they're locking in the bulk of their housing costs before inflation raises the bar again. And demographics remain favorable with more than 45 million households in the 26 to 35 age range, which are key years for household formation and first-time home buying. Now, if you're concerned at all about what a housing crash might mean to your portfolio, and if you understand that there's a supply and demand components for rates and that rates are likely to come down and bond prices are rising, and you need a strategy that hedges the market risks of this, well, be sure to check out Portfolio Shield. I'll put a link in the corner in the description below. You'll be glad you did. So now let's look and see what are the odds that the housing market is going to go down and crash. Well, let's take a look at some slides I put together here because is it an issue of mortgage rates? Is mortgage rates enough to do it? And the answer is no. I've got the U.S. National Home Price Index here in blue, and I've got mortgage rates. And yeah, we can see here going into the great financial crisis that rates were high, but they came back down relatively quickly. And well, of course, we had a financial crisis, which really hurt prices more than rates coming down. But notice here, you can see there weren't any period that where you see higher rates really curbing into demand too much. So it's not an interest rate story. Now, is it a story about the Fed? Well, I think there's actually something to this chart. And we're going to look at this a little bit deeper, but there's two things I want you to focus on, or two parts of it. It's where the Fed is tightening and at what rate. So let's look at the federal funds rate going back into the early 1990 recession, and notice how fast the federal funds rate went up. Now, we saw the Fed raise rates before, but it didn't have an impact on housing. And then, of course, you look here at the dot-com bubble, and the housing prices still continued to rise, even though the Fed had raised rates. But now, look, going into the great financial crisis, notice how quickly the Fed raised rates. Over here in 2016 through 2019, notice the pace of the Fed's rate hike really was slower and didn't have an impact. So what is the issue here that could drive housing prices lower? Well, we're going to go back to our old friend that we've been talking about just the other day and last week, and that is the yield curve. Because what's important to understand here is banks borrow at the short end. So they borrow at very short-term rates, and they lend out at long-term rates, and they make money on the spread. And when those spreads contract in together and they become at parity or even worse, inverted, as we've talked about, well, the banks don't want to lend because they can't make any money. So check this out, and I think this will make a whole lot of sense of what's going on, is we can see that there was an inverted yield curve on the 2 10s, the 10-year Treasury minus the 2. And there we see the housing price index started to come down a little bit in this recession. The second one, there wasn't much of an impact because the Fed wasn't really raising rates all that quickly. Then the great financial crisis, massive inversion, that leads to a crash in housing prices. The next one doesn't. So it almost seems like every other time the Fed ends up crashing the housing market. And of course, how do they do that? By tightening too quickly. And if we think about what's going on right now, what's been tightening too quickly? We have a withdrawal of fiscal stimulus, the end of QE, and now we're hearing about rapid rate hikes. And this today from Federal Reserve Bank of San Francisco President Mary Daly, she said has, quote, everything on the table for the next policy meeting in May, as both a 50% basis point high interest rate hike and a decision to shrink the balance sheet could be warranted depending on the economic data in the coming weeks. Well, Mary, at the rate we're seeing the housing market and start to dry up with the lending demand go down, we're likely to see unemployment start to rise. But if you knock rates up 50%, I'm going to tell you who's going to crash the housing market. It's going to be the Fed, and they've done it every time. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only. It's not intended to provide investment advice. You don't have to be construed as recognition, solicitation, buyers, selling securities, financial instrument, or participating in particular trading strategies. Very West paid by Steve Van Metre. Or person passive opinions expressed this video and do not affect the view of Alice Inc. or Steven Van Metre Financial.